So we don't usually talk about trading strategy because it's not something we usually cover because we're more of a news-based group, and we try to give technicals and fundamentals as they happen, but trading strategy is obviously one of the most important things that you're going to do as a trader. And when I say trading strategy, most people will come up to me and they'll say, okay, what do you use, an RSI crossover, a MACD, do you use simple moving averages? That is only one component of a trading strategy, and it's important to realize that there is a number of things that go into a trading strategy, which we'll talk about in just a second. But it is important to realize that a trading strategy encompasses everything you're going to do with that trade and to bring it to the future. You're not trading once, you're trading over the long term. So it's important to have a strategy that takes in all these factors into account. Okay? Now, first thing, as always, risk disclaimer. We always have to do this, and it's very important that you realize that trading with leverage, regardless of the asset class, is going to be dangerous. If you do not take it seriously and you do not use the right strategies for risk management, then you can lose your entire account, perhaps even more, because you're using leverage. It's very dangerous. And also, you cannot record anything here because it's just not allowed. Because we're already recording these, and hopefully we're going to put these up on the website relatively soon. So if you want to come back and look at it later, you'll have the ability to do that. All right, so let's move on. Why should we have a trading strategy? A lot of people will come up to me and say, why should I have a strategy? I know there's so many famous traders out there that they don't seem to have a strategy. They seem to know, they have the gut sense that they can just go in the market and trade, know when to get in, know when to get out, and they'll make that money consistently. I'm not gonna lie, there are some people that have that ability, and it's not gonna be me. I already know that, all right? It's just not my personality. Some people are hardwired for that personality, and typically those type of people they're the most obnoxious people you're ever going to meet. Okay, I'm not going to lie to you. I've met a couple traders that do discretionary-based trading, and they're successful, and a couple work at banks. They are obnoxious. I cannot hang out with them for more than 10 minutes. Okay, it's true. All right. So why should we have a strategy as regular traders, regular retail traders? Okay. First of all, it makes monitoring trades much easier. All right. I'm going to assume you know that you can have more than one trade on at any one time, and that you should if it meets your criteria. All right? But if you have, let's say, 10 trades on, and these 10 trades have been placed over the span of 2 weeks, will you remember what that first trade was based on 2 weeks ago? If you've had so many trades since then, unlikely. I know a lot of you have good intentions to write everything down, but obviously that falls apart very quickly because it becomes very tedious. So it really helps to monitor your trades over time, to have that consistent strategy. You know that I took it because of my breakout strategy, and that was what I'm sticking with on this trade. So you can always go back and you know what the setup was for it. It also introduces the form of consistency. You're not in it for one trade. This is not a gamble. You're in it for the long run. You want to make income. You don't want to make a one-time trade of $1 million. Well, of course you want to make $1 million in one trade. Anybody would, but you're not going to. I'm just going to tell you right now. And if you're around for my money management course, I'll tell you why that's not going to happen. But it introduces the concept of consistency, and it really helps with trading over a long period of time, which most of you, I'm sure, plan on doing because you're already here taking the steps of education. All right. It also improves the ability to spot opportunities. If you already know that you have a breakout trading system and you know those rules of the breakout trading system and you have done it enough times, eventually you're going to start to see just by looking at a market that it's probably going to meet your conditions. You don't need those indicators. You don't need those definite price setups. It's already there. You already see it, and you're going to probably react to it. So it really helps you to spot opportunities that you otherwise would not see. And then it also tells you when not to trade. No one likes to hear this, but you should not be trading often. Okay? Sometimes market conditions do not fit your specific strategy. Oftentimes the markets just are not conducive to trading regardless of what your strategy is. There's just these times that it should not be. And your strategy will tell you not only when you should be in, but when those conditions are not met, that's when you should not be in. Okay? Very important.
Now, what are the actual essentials of a trading strategy? We're going to go down a list here, and it might surprise you which items you find on there.
Your first one's up.
Establish a directional bias, as you can see, is only the first thing on here. So all of the things that traders typically would call a strategy, whether it's technical, whether it's fundamental, is really only the beginning. That's really only where your trade begins to take shape. You establish your direction, you establish if you want to buy or sell, you establish where you want to buy or sell. But before you ever place a trade, before that idea ever translates into an actual position, you have to determine how much am I willing to risk? What's my target going to be? Do these levels make sense? Do they justify placing this trade at all, regardless of whether this met my setup as far as technicals or whether the fundamental trigger is compelling or whatnot? You have to define your time frame. I'm sure a lot of you have placed a trade thinking it's going right up or right down, and then the market just kind of meanders there for a while. If your setup, if your trade was based, let's say, on an hourly chart, and you're in day 3, maybe you've exceeded the time frame that signal was based on. Maybe, I'm just saying. So you have to define that time frame before you head in. How long are you going to allow this trade to sit there and work or not work before you say, okay, well, the reasons why I got into this probably no longer valid. I don't want to be in here. And finally, utilize risk management, which John will devote an entire session to later on today. But this part of it is easily the most overlooked and also easily the most important. It is absolutely critical to screen your positions regardless of how good the signal is, regardless of how good the setup is, how compelling the news. Does this trade make sense from a risk to reward perspective? Do I have a setup where the risk I am taking justifies the reward that I want to have? And if they're equal, that's a coin flip, and you probably don't want to be there.
All right, let's move on. All right, so first, before you get into qualifying your actual strategy, all right, your directional bias and all that, you need to know what kind of trader you are. All right, many of you already know perhaps that you like it when you make quick profit. I mean, anybody's going to know that, all right? But realistically, you need to know the time frame that you need to be in and kind of what your biases are towards those time frames. Can you hold through a long-term chart? Can you stay with a trade that lasts for 2 weeks and the likelihood that you can get a short-term drawdown? That could be pretty significant. Can you live with that? If you can't, you're most likely an active trader, all right? These boxes are skewed. I'm not happy about that. But anyways, you're likely a short-term trader, an active trader. If you want to get in and out very quickly, if you plan on making trades and you have to be there for that trade, you're probably an active trader, okay? I'm taking the Jeff Foxworthy approach. You're an active trader instead of you're a redneck. But if you know that you're going to, let's say, if you can't hold the position overnight, you're an active trader. All right, very important to know that. And if you plan on making multiple trades per day and they're supposed to be completed, you're an active trader. All right. I have a strategy here that just kind of illustrates that. And what you see at the bottom there is an ATR, average true range. All right. It's just kind of a gauge of how large the bars are for that specific range. And this is in a, 15-minute time chart. Note this is the Aussie dollar. We're going to follow through the Aussie dollar because I personally hate it. And we'll show you through this example. But right now, this is an example of an active trader time frame. All right, this is a position. I'm just trying to show you that you can have a different type of approach for the same currency, and it works regardless. You just have to work it correctly. All right. So what we have here is the ATR, average true range, average range of a bar for a 15-minute over the past 14 days, or 14 bars. So what you're seeing is that's the average range you would expect. Now, during certain periods, it actually dips below kind of a level that I thought was a very interesting level, 0.8, because it does match up, if you see those lines, it matches up with periods of relative congestion. So you can really identify where it's going back and forth, it's choppy, and it's not really moving towards breakout and momentum. It's not really getting something that would get away from you. You can get in and out of that in that time frame a number of times, so you can get a multiple number of trades on range base. So this kind of highlights those periods where it actually worked in your favor. Ignore that box on the right because it's skewed way over on the line. I don't know why. PowerPoint probably. All right, so now let's move up. We have swing trade. Okay. This is typically where I would label myself. This is between perhaps 2 days and up to a couple weeks, maybe even beyond, but going beyond that, you're really getting past it. The swing trade should take some time to establish. Its stops are going to be a little bit wider. Its targets are going to be a little bit larger, and you're going to take fewer trades. Active trade, if you're doing an active trader, you're doing scalping or something along those lines, you can have many, many, many trades per week. If you're doing a swing trade, it's likely that you're going to have maybe a couple trades per week because it takes longer for these formations to set up. You're looking at a higher time frame chart. So what we're looking at here is a daily chart, 3 years of worth of price action. And we see a rising trend channel, okay? So that gives us kind of after the first established bottom trend channel, then you have the two touches on the top, then you start seeing that there's that channel there. That channel starts to draw itself. And when where those circles are, that's when you can start saying, all right, there's something there where I can start taking positions on a range base. All right, those swings take about 2 weeks to establish. They could take a little shorter if you want to take profit earlier, which is sometimes a good idea. But you can see how long it takes and the higher time frame you have to use for that swing trade. I would say many of you are best suited for this. And I think that it just takes patience to get to that point. But this is really where most people are successful when they are to that level of success. And then we have the position trader. This is Ilya. This is the people that can just sit on it forever. And I can't do that. That drives me nuts. But what we see here is the Aussie dollar once again. This one's a 1 day, 3 year time frame. Okay, so we do have a very big picture of what's going on. And let's say that 100-day SMA, which we have right back there, the big thick blue line, is our signal for entry, and it gives us the relative direction of the market, and the pitch of that moving average actually gives us the momentum behind it. So you would know to get in on that cross and get back over and get out when it crossed back on the other side. So you would have held it for a very long time, made a lot of profit. So these are the type of positions that have very large targets, very large stops as well. So you have to be able to handle that, and they're going to have far, far fewer trades. All right, you're going to have to be very patient. And I know a lot of us really want to trade all the time, but this is where patience really has to come in.
Now, when you've decided you're going to be a swing trader or a position trader or whatever you've decided your style is, or even a hybrid of styles sometimes, the first thing you have to do is essentially qualify what is going to be your trigger to have a trade idea. What is going to tell you want to be a buyer or a seller, or maybe you don't want to trade at all. Maybe something is not compelling. You begin with the fundamentals, and the first layer is going to be the macro picture. Where are interest rates going in the next 12 months? What's economic growth rates going to be from one country to the other? How will that play out? Are there correlations that exist between certain currencies and certain other markets, like, for example, the Canadian dollar and oil, or the yen and the stock market? That allows you to essentially qualify what the playing field looks like. What are the overall conditions that you're dealing in? And the second is going to be an event trigger. Essentially, what within that environment that you've now established is going to tell you, okay, I want to be long or I want to be short, or I want to not trade at all, or I want to rethink my landscape.
Now I'm going to come to technicals. All right. All right, so qualifying the technicals is not like qualifying the fundamentals, but actually they might be two different types of analysis, but you would be surprised how often they cross over. Technicals are often a reflection of fundamentals, especially when you're talking about the long-term fundamentals. All right, when you're talking about trends, fundamentals actually come into those technical trends. They establish those technical trends. And while there may be other things in it, like speculation, it is a reflection of it. So don't think they're two separate. That's why I always argue for people that are on one side or the other that they should definitely incorporate both into their strategy and use them in coordination with each other. All right, but first, qualifying your technicals, period technicals, you need to establish your key levels. And including that key levels, you also need to establish your kind of trend, your bias. And that bias is already established generally with a fundamental macro look, but it also is good to confirm that the market is following what those fundamentals say it should be following. Okay, so you want to also look for those levels, and when we say levels, it's if you're familiar with the stock market, which most of you probably are, you know that the Dow Jones Industrial Average, 12,000, 11,000, 10,000 psychological levels, right? They're important levels. And you already know that those are important levels because they've been established before and they've actually held back the market from as resistance and support in the past. So you want to establish these key levels, whatever pair you are, and different time frames as well. All right? And then you need to see price events. And what by price events, I mean like a breakout, a reversal on a specific technical level. These events can also be patterns. It's when the market is in action around a technical level and it's actually playing out. There is something behind it. It could be momentum. It could be anything along those lines where the market is actually in action and you put those technicals at work. So you have passive and you have active technicals that you both have to look at. And they're very important, both of them. Both of them are essential to your strategy. Okay?
Now, when qualifying the fundamentals, we'll sort of run with the same Aussie dollar example that we've been going here. Right here, we have the difference between expected interest rates for Australia and those for the U.S. for the next 12 months. And what we see here, starting from about this top here, is the spread is getting smaller, which essentially is telling us that the difference in expected interest rates, the advantage that Australia is expected to have, is shrinking. So perhaps that sets us into a mindset, okay, well, if traders are starting to expect this Australian advantage to be smaller, maybe I want to be thinking about a short position on the Aussie dollar. That kind of frames your thinking. Now, as far as a trigger, just 2 weeks ago, the head of the Australian Central Bank came out and said that borrowing costs were pretty close to average. Now, they've been saying for months that where they want to take interest rates is close to average. So maybe what we're seeing here is the central bank telling us, we're about done raising rates. Maybe not totally, but we're getting there. And maybe that's the trigger you need to say, okay, these interest rate expectations have been easing down, and this is my trigger. This is how I know where a compelling trade may arise. The other side of this for the Aussie dollar is risk appetite. And what we have here is a chart of the currency in blue there, and in red, the Dow Jones Industrial Average, essentially a proxy for global stocks, as it were. As we can see, they look pretty close, right? The reason being is the Aussie dollar is a high-yielding currency, and so when people want to go for higher yield, and higher risk and are generally more tolerant of risk and therefore shooting for a higher return. If they're a more traditional investor, they're saying, I don't want the safety and the low return of, say, bonds. I want stocks. The trade-off in Aussie dollar is about the same, logically. I want the higher yield, the higher interest rate, as opposed to, let's say, the safety of the US dollar. And that's why you get this correlation. And once again, this sets you up in an environment, and then your trigger, risk appetite falls apart as the S&P downgrades Greece to junk status. Investors panic. They are no longer as interested in risk. They are much more interested in safety. And maybe that once again gives you a trigger to say, okay, maybe I want to be short.
Now we're going to look at the technical side of that. All right, as we hash up the same chart we had before. This is about 10 years, zoomed into 3 years, and it's a daily chart. Okay, and we have that long-term directional trend. All right, we have that simple moving average. Once again, this is a 200-day SMA. All right, many people use these simple moving averages because when they break, after a significant time of holding them, it gives a good signal for entry themselves. So maybe we want to wait until that happens, but it's starting to look like you can see that congestion over the past 2 months, 2-3 months, and it looks like the trend is starting to cool off. While it might go a little higher, it's not going to go as quickly and it's not going to go as far as it would have beforehand when you were earlier in that trend, when it was really backed by momentum. All right? So now you can see that SMA, which is a relatively simple indicator, it's an indicator on all charting packages, becomes a really good gauge for trend. And we have that trend and we know that trend. When will that trend break? It may take some time, and we can also qualify it with different things, but nonetheless, we can see it. It's there. Now we go to the shorter time frame and we say, all right, maybe I want to start taking some short interest and maybe see when there's some turning. It might not turn all at once. It happens that these trends turn into congestion for an extended period of time. It doesn't immediately turn into a reversal. There are very few V bottoms, V tops in economics, and there are very few in markets, okay? Because things don't change that quickly. And if they do, it's a dramatic event. So what we're going to start to see is maybe we start looking for short interest. Maybe we should start considering the short side instead of taking long trades all the time. So we draw this rising trend channel, and we have that floor with the SMA, the 50-day SMA there as well. So there's a good establishment of congestion there. So maybe we want to take Maybe we want to take a short entry, perhaps around there somewhere, and start to see what kind of downside we can start to get. Okay, you're starting to think a little bit more about the short side, and you're turning off this long side. You can still take long trades because it is still a dominant bullish market, but we're starting to see the signs that it's being more and more dovish or bearish.
Now, before you ever actually act on this, so you have your environment, you have your trigger, you have your compelling technical setup with your very nice channel.
Thank you.
And you say to yourself, okay, I'm about ready to start thinking about a position here. But before you ever do any of that, before you ever pull the trigger on an actual trade, you have to decide where, which is not as easy as it sounds. Right? You have your trade idea, it looks great. But is this the price to get in? Or maybe I wait 10 minutes. Or maybe a day. Or a week. Which price do I want to get in? What's more attractive? Where do I get out? What if I'm wrong? What if the trade actually goes in my favor? How do I know when to take profits? And what if you are wrong? What if it goes against you? How do you know when to essentially say, well, it's one of those. I'll get out and I'll wait. and try again. And finally, how much will it cost to place this trade? And does placing this trade make sense given that cost? And I don't just mean spreads here. I mean things like rollover. If you're going to be short the Australian dollar, which is a relatively high-yielding currency, you're going to be subject to that rollover. So you have to ask yourself, okay, well, if my time frame for this thing is a week, do I want to do that? Do I want to incur this rollover? Does that make sense given my profit target? Will this substantially detract from my profit so as to make this trade not interesting to begin with?
All right. Now we're getting into the actual fun stuff that you guys are probably more familiar with. We're actually looking at the trade dynamics, the mechanics of trading. All right, and this is just a sample. Don't go out and take it. But it is relatively active, though things have started to occur in the past 4 or 5 active trading days since we've last updated this. But first we're looking at selecting the qualifications for entry. All right, this is where most of you guys are starting to see your trade. This is what most of you consider a trade. All right, you have your RSI, or you have a technical break, or something along those lines that typically enters your strategy. This is the first part, though. Okay, and the first thing you need to do is establish where's your entry. All right, for this example, we have that same rising trend channel on the shorter, about 3 or 4 months worth of price action, and we had that break of the rising trend channel, and it did pop back up. That's fine. So maybe we want to get an entry short when it gets back into the middle of that range. All right. So that's what our hypothetical scenario is here. Next, then we need to establish where is our cut point. Where can I take no more, or more appropriately, this is the way you should be thinking about it. Where would I not want to get in again? Where is this trade no longer appealing to me? Where is this not the same trade setup? And where will I have to get out and rethink the entire thing? So that's your stop loss. All right, we placed it up there at 93.40 and putting it just above that short-term descending trend line. It's not fully covering that swing high. And I made that on a purposeful decision because if it gets up to that swing high, it's a new trade. It's not the same thing for me. It would be something completely different. Then I'm trading something like a double top, and the likelihood that if you see a double top, that you get a little further above, and then it pushes that a little bit to clear out some long side entries or some short stops or something along those lines is much higher. So the likelihood that it can fall through a little bit is higher, and it'll go up, and then it could perhaps reverse back down. But you don't want to hold it through all that. You want to get out back when it looked like it was no longer the same trade. And then for the grand finale, I'll let Ilya go for it.
And now the really fun part that everybody always likes doing. Profit targets. And I stress targets because you don't necessarily have to have one. What I often end up doing is actually having multiple targets, or even having soft targets, which for a position trader like myself who holds trades for a very long time becomes essential, because I don't want to cut a trade that's based on the macroeconomic environment for the next 6 months. I may not want to cut it off in a week and get back in. I may just want to hold it. And so maybe I have a soft target where I think the price will get to, and which will trigger me to trail up my stop and take some of the risk off the table. But in this case, what we do is we set up a conservative target, which essentially is where we'd like to initially get to at the psychological barrier at 92. I say it's a psychological barrier because round numbers tend to be, generally because the markets are obviously a collection of people just like us, and they like to think in 10s and 5s because that's convenient, as opposed to 7 and 9s and 3s, which is not convenient. And then the next target at 88.50, which is a more aggressive target, a sort of best case scenario. Now, as I mentioned before, it is extremely important to set a realistic time frame for your trade and know when the trade has essentially gone past the logic that went into it. The example that I mentioned before, if you're on an hourly chart and your setup and your trigger took, let's say, 3 hours to develop, and you place your trade and you're about 2 days in and it's still not doing exactly what you thought, maybe it's time to get out. Maybe the reasoning behind this trade is no longer valid. Or maybe if you're a position trader like myself, maybe your reasoning doesn't change for months at a time. And if you have a blip in the chart because some sort of news comes out and the market spikes, maybe you don't care about that, regardless of what it does to price action. Because you're in there for the long haul. You're in there for 6 months. And economies obviously don't turn on a dime. The macroeconomics take time to play out. So maybe you don't care about that, but you have to establish those things before you get in so that when those events happen, instead of panicking, you go back and say, okay, well, this was my trading strategy. I knew I was going to be in for about this long. I'm still within my parameters or not, and I'm going to act accordingly. The key, of course, is to know when your strategy is wrong and when it's not. And my favorite quote that I threw in here is from hedge fund investor Ira Harris, who basically summed it up perfectly, saying, if you're right at the wrong time, you're wrong. I try to repeat that to myself as a mantra on a daily basis. Because being a position trader and looking at long-term fundamentals, my ideas often show up in my analysis months before it's an actual trade that's ready to be taken. And I end up being early quite a lot. And so I repeat this to myself as often as possible. And finally, money management. Remember, this is not a gamble. You're not trying to get lucky. You're trying to actively and proactively strategize how you are going to succeed in the long term. There is a myriad of new traders who make basically the same mistake when it comes to money management. We're all guilty of it. I certainly am very guilty of it. I'm sure John...
Absolutely not.
Yeah, of course. When you begin, and I'm going to ask for a show of hands here, you have, let's say, 5, 10, 15 profitable trades, and then one trade wipes them out. Yeah? Yeah? Telltale sign that your money management is off. Okay? Because you have to think about this for the long-term perspective, as if you're running a business, rather than speculating. And so you want to focus on the size of your winners and losers, as opposed to just the number. Right? Because if you're employing proper money management, it doesn't matter if you only get a third of your trades right. You can still be making money, as long as your money management strategy is sound, And as long as you are never, ever, under any circumstances, risking more than half what you're looking to gain. Or to put another way, employing a 2-to-1 risk-reward ratio. Because if you're doing anything other than that, if your risk is equal to your target, that's like flipping a coin. And that's certainly not a sustainable way to manage risk. It's very critical to always stick to your rules and never change them. Another thing that new traders, including myself, but of course not John, that everybody is guilty of, is the price gets close to your stop and you go, I set this stop wrong. I'll just move this right out. It'll turn. It's going to be fine. But what you actually just did is, of course, heap on a whole bunch of risk on your position, which is exactly the opposite of what you want to really do. And so you absolutely never, ever, under any circumstances, having established discrete rules that are going to guide your entry and exit, want to change them. Unless, of course, you're moving your stop to break even to take risk off the table. Or trailing your stop down to lock in some profits. But you certainly never, ever, ever want to move your stop against your position. Most importantly, with position sizing, is that timing element that we discussed earlier. If you're going to be a long-term trader, and this I know all too well, cannot use a lot of leverage. You cannot put on large positions relative to the size of your account. Because if you're going to hold this thing for 1,000 pip profit over the course of 3-4 months, your stop is going to be 250 pips maybe, 300, something like that. My stops are even wider than that most of the time. And if I have a huge position, maybe I'm not going to be able to sit through that. So if you're a longer-term trader, you don't want to use a lot of leverage. Whereas if you're a shorter-term trader and you have firm stops that are close in, maybe you can allow yourself a little bit more room to ramp up the leverage a bit. I stress a bit. Because leverage, of course, is a double-edged sword. It amplifies losses just as well as gains. And another quote here from another very, very famous hedge fund investor, essentially bringing it all home, is it's not whether you're right or wrong that's important, but how much you make when you're right and how much you lose when you're wrong.
So a few more things that we want to think about is that you are not just one strategy, okay? You have a strategy that you might think is successful, but perhaps it's successful for a 3-month period, then it starts to go all wrong. What happened there? That was a strategy that was specifically tailored towards a specific type of market. All right, it's important to realize that there are different market conditions that you are trading in. Your strategy, while many people think that they have a holy grail and that there is a holy grail, the likelihood that you have a strategy that can weather breakouts, range, trends, extremely volatile markets all at the same time and remain consistently profitable is you're probably deluding yourself, because that kind of thing does not exist. So you want to make sure that you have something for trends, range and breakouts, or erratic swings. You want to have different positions, or perhaps this kind of strategy can be adapted to it. So you keep the background, the fundamental creation of the strategy, what it was really made to do, but then you adjust a few things so that it's better tailored towards the type of market that you're in at the time. Okay? You should also have different time frames. Okay? I usually suggest 3 time frames. You're going to use your standard time frame that you're looking for the trade to take place in. You're looking for one higher to look at the larger trends or perhaps the larger levels of resistance and support. And this also applies to fundamentals as well. And the shorter time frame, which you also want to see for perhaps something that gives you entry. So your signal for entry. So typically what I use, I like to trade on the daily chart. I'll roll down to the 60-minute chart for that's my entry level, or maybe even the 120-minute moving average, or 120-minute chart, so it's a 2-hour chart. And then I'll go up to perhaps the weekly or the monthly, just to check where the trends are. Where's the trend? Where are the bigger levels that I need to watch out for that perhaps I'm making a really technical-based trade on a daily chart, but with that breakout, maybe there's something I don't see that the weekly chart is giving me. Okay, so you need to have these different time frames and be aware of them. You can also trade in those different time frames, but let's say you take a trade in the 60-minute chart, then you got to move down for entry to something perhaps of a 15-minute, and then you move up to something perhaps as a daily for your long term. Okay, so you should be proactive in using those different time frames. And then also, you need to adapt your strategies over time. As I said, you need to be able to switch not only to the market conditions, but perhaps things really change. Maybe Greece is no longer the economy it is. The euro's looking kind of funny, and it's not acting like it used to. You need to adapt. You need to change that strategy. Perhaps it no longer works anymore for some unknown reason. But if you see that it's not working, you know specifically why it's not working. Perhaps it's a stop. The stop is too close. Maybe you need to widen that stop a little bit and increase the target a little bit. And you need to adapt those strategies. You've got to be flexible. Strategies do not last forever. Even the best of the strategies have to be changed with time. All right. So now let's take it to our personal views. First mine, because it's most important. My typical trading strategy, this is the same thing we get in the analyst picks if you go to the DailyFX website. My background is fundamentals, but my confirmation is technicals. I look at technicals and fundamentals. I think they're vital to each other, but I more go to the fundamentals because that gives me where my direction is, where I should be going. And then I look for a time frame of usually 3 days to 1 week. I don't have the mental capacity to sit on something for months at a time. It grinds me down. I cannot do what Ilya does. I'm just not built for it. And I get tired of looking at a computer screen if I have to stare at it to get in and out. So I cannot scalp. I cannot do these intraday trades because my eyes start to burn. I tried it. It does not work for me. All right. I always have clear stops and targets. All right. There are people that can move them. Perhaps they have adjustable second target. I don't usually do that. I like to have clear, concise levels that I need to get in and out and just go with it. Because sometimes I have a propensity to go back to emotions. And even though I try to work against it, they're still there. I'm still human. I want to be a robot when it comes to trading, but I like to keep those human characteristics. And then also, in terms of how much I want to risk per trade, I go sometimes down to 1% of my entire account, but sometimes I go all the way up to 5% of my entire account. Depends on how confident I am in that position, fundamentally and technically, and how likely it looks like it can play out within a certain amount of time. And then finally, my position size is defined totally by the risk. If you look at a chart and you see that there is a clear technical level, and actually, let's just take it forward. So you're looking at this. Perhaps I want to go short here, and this is the Kiwi dollar. And you see that descending trend line. It goes actually further back, and I see that I can place a stop above that swing high that we had the fourth bar back, and that would be a really good level to place a stop. I will define my stop size depending on where that's at. I will not try to give up my technical levels just to fit that 1% of my account. Instead, I'll change my leverage to meet that technical level. So that's a great technical level. It looks very good. Got to use it. So then I just change my account size, my position size, so that it fits. That if that completely loses, it's still 1% of my overall account. All right. And doesn't really fit the actual standards that I had for my typical. I went a little outside the box on this one, and it was one that I did just I think last week. It was a very quick one, and I liked it a lot. Actually, we saw a significant plunge in a Kiwi-US dollar pair, specifically because Greece was downgraded to junk, and so did Portugal get downgraded as well. So we had a big sell-off in risk appetite. It was very clear. Everyone knew it was going to happen eventually, but didn't know it was going to happen then. But the fact that people knew it was going to happen eventually, because things in Europe are already bad as it is, so it's already starting to price in that risk aversion. We saw it come down, and it certainly came down extremely quickly. If you look at the shorter time frame, it was in a matter of, I believe, an hour and a half. Very sharp move. And then it stalled for about 4 or 5 hours. And I thought, all right, we already had a risk aversion priced in. We knew that this was eventually going to happen, and that was an extremely volatile move coming at the bottom of a channel. So we already had momentum go by. We have a clear technical support. So what I did was I took a long position. I think it was 25 pips off the low. Or no, sorry, 10 pips off the low. And I knew that it was going to eventually start rising. I didn't know how much, so I set my target about half that bar's range. And that was relatively conservative, I know, but I'm not looking for too much because things are very dynamic, and this is a relatively narrow channel. So it eventually, after I think 3 or 4 hours of the turnover of the day, it made the first target, and I was out. And I set a second target just 5-10 pips above. Kept it really tight, very quick trade, and it was all fitting into my fundamental and technical biases, but I just changed the time frame. But I also had to change the stop, and I had to change the kind of approach to my strategy.
Swing traders. Terrible. My thinking is that macro fundamentals really don't change that often. Trade patterns lock in for a long time. Interest rate cycles lock in for a long time. And so I really see no need to fight the trends that kind of environment sets up. And so I hold for a very long period of time because macroeconomics takes a long period of time. My basis is essentially where I think the global macro environment will be 6 months out to about 12 months out. And then I use technical analysis to essentially guide where I actually want to place a trade, having established that bias. As I mentioned, my time frame is about a year, give or take. Sometimes it can be significantly less. Sometimes it can be even more. But I like to think of my trades in terms of where is the global economy going in the next year, and sort of move from there. Because I am so long-term, I don't actually set physical stops or physical targets. Because what I don't want to do is I don't want to cut a long-term trade short. I want to give it time and space to develop over time. And so what I do is I establish a soft stop loss and a soft target. Essentially levels where I will cut the position if I see a daily close breaching them, and then also a target that essentially works the same way, where it is a certain level where I think would be a reasonable inflection point, where things could turn on me, where there could be a bounce. Or key levels where, if broken, would expose more trending in the same direction. And again, rather than setting a firm limit there, I'll look for a daily close that breaches those levels to essentially then trail my stop, take some risk off the table, and then establish where I think my next target should be. As far as risk-reward, as I mentioned before, the most critical thing for me is the risk-reward ratio at least 2-to-1? If it's not 2-to-1, based on where I think a reasonable stop and a reasonable initial target would be, I will not be in the trade. It's a very strict filter. And if any of you follow my articles on Daily FX, you'll see a lot of times I'm not trading. I'm sitting on my hands because even if a technical level was breached, even if I have my fundamental trigger, if the risk-reward doesn't make sense, I don't want to be there. And as far as position size, because I employ such a long-term approach, I never want to leverage more than 10 to 1. Now, I want to qualify that because I am not talking about margin, and I'm not talking about essentially the margin rate, which is what a lot of you might think of as leverage, right? 400 to 1, 100 to 1. I'm talking about account-wide leverage. So when I say 10 to 1, what I'm saying is if I have, let's say, $10,000 in my account, I will never have more than 100K in total exposure. So essentially, the amount of money I have in the account is never at a greater proportion to my total exposure in the market than 10 times. And what I like to do is usually scale into that. So begin with maybe 5 to 1 or even 2 to 1 and build a position as it develops in my favor, hopefully. So here's an example. I was thinking that over recent years, the U.S. economy was going to probably rebound faster than Europe, and Europe had a lot of structural issues, which we're beginning to see now, that make managing a crisis very difficult, because obviously we have a whole group of economies, very different economies, that require different monetary policy, but only have one central bank, but then different governments, so fiscal policies are not aligned. And I figured that that would complicate their rebound, and so the central bank would need to keep interest rates lower, longer, than a more nimble economy like the US. And so I wanted to be broadly thinking about selling euro, US dollar. And then I waited and waited and waited, and on December 7th of last year, I saw my signal. On a daily chart, I saw a dark cloud cover candlestick pattern. And if you'd like to know more about candlestick patterns and how I use them, please feel free to ask me after the presentation, or see the candlesticks section of Daily FX, where I discuss all this stuff. And I saw a break of this channel here, which held over a number of months. And that told me, okay, maybe it's time for this overall macro picture that I've painted to start playing out. I established an initial stop, whereby I would manually close the position if prices issued a daily close above that level, because let's say in the case of a spike like that, I don't want to be stopped out on that. I don't want to be stopped out if prices just kind of pop up there and there's a stray wick, because I'm looking for the long haul here. So I want to see some conviction behind a hit of my stop loss. So I want a daily close above that. And then a soft target, which is sort of there to manage risk and see that 2 to 1 risk-reward ratio. That way, if it only goes here, that trade still makes sense. I don't want to assume that it's going to run down for the next 12 months. I want to set a realistic target given where my stop is and sort of take it from there. And so I went short right here, and I'm still in this trade. And thankfully, euro dollar made new yearly lows today, which is good for this position. I'll probably be revising this target lower again at some point, once we get sort of comfortably below 130. And that about wraps us up. We have our email addresses here. They're conveniently organized as our first initial and last name at dailyfx.com. You can feel completely free to email us with any questions. These presentations, as well as the videos that we're shooting, will be available. And we'd like to open it up to your questions.